Hello everyone. What we're going to take a look at here is the homework that was assigned for Chapter 12, the last chapter that we're actually going to study in this particular semester. So the first item that we're going to take a look at is actually exercise 12-3. And this is on page 563 in your textbook. There's really no number crunching here, at least for the first couple of exercises that were assigned for homework. What we're going to see here is we have a list of items that are accounts that belong on the income statement. In this chapter, what we have done is we've actually broadened the different categories of the income statement. And you can see that on page 536 in your text. And if you flip to page 536, you will see that the various sections of the income statement are as follows. First, we have the sales section. And in the sales section, that's where you have your sales less your contra sales accounts. The next section is the cost of goods sold section. And that equals a subtotal. Sales less cost of goods sold leaves a subtotal called gross profit. And then from there, we're going to subtract out all of our operating expenses, which are further broken down between selling expenses and general expenses. And then we get a subtotal called income from operations. From there, we're going to subtract out any other income and expenses that really have nothing to do with day-to-day operations, but they are indeed earned. Example, that would be interest income or interest expense. And then finally, we get to net income. So this particular exercise is giving you different accounts, and we need to decide where it would actually be recorded in the different classifications on the income statement. The first item is advertising expense. That is typically a selling expense. Rent expense is next on your list. That is considered a general expense. Now, once again, comparing to what you see on page 536, I just want to reiterate this operating expense category is further broken down between selling expenses and general expenses. And you can see the breakdown of this further on page 539 in your text. Okay, the next item, purchase discount. This is a contra purchase account. This you're going to see in the cost of goods sold calculation. Sales returns and allowances, as we've talked about in the past. This is a contra sales account, and this would indeed be part of the sales category. Interest income. So this is interest that we receive from most likely the bank. It has nothing to do with day-to-day operations of the business, but it is indeed income. And we're going to put that in an other income section towards the bottom of the income statement. We have freight in. This is the freight that we pay to buy the inventory and ship it to us from our suppliers. That goes hand in hand with the purchases account in the cost of goods sold section. Depreciation expense on the building. That is typically an operating expense, most likely a general expense. Now, if it was on the actual store, in the storefront, that would be a selling expense. But it's on the building, I'm assuming the general building. Interest expense, similar to interest income. We do spend money when we borrow money. That isn't part of day-to-day operations, but it is an expense that we would put in the other expense category. We have insurance expense. That is typically a general expense. And delivery expense. Obviously, in order to deliver to our customers, that is an expense that needs to be incurred. Therefore, it would be a selling expense. Once again, you can find the detail of the different categories of your income statement on page 536. And further breaking down the operating expenses into selling and general expense categories, you can find that on page 539. Okay, the next homework problem is actually exercise 12-5. This is on page 564 in your text. And very similar to what we just did in exercise 12-3, we are breaking up our categories on our balance sheets into further categories. You can find this on page 542 in your textbook. And basically put, there are two sections of assets, and there are going to be two sections of liabilities. Actually, two sections of assets and two sections of liabilities. Looking at page 542, we can see our assets are further broken down into a section called current assets and a section called property and equipment. The current assets are those assets that are going to be converted to cash or used up within 1 year of the balance sheet date. The property and equipment are what we consider long-term assets. Those are assets that will not be converted to cash or used up within a year. All right, they have more of a long-term nature to them. Now, if you work over to the liabilities side of the balance sheet, once again, I'm on page 542, you can see that the liabilities are broken down between current liabilities and long-term liabilities. And using the same logic that we talked about when we talked about the assets, the current liabilities are those liabilities that are going to be paid up or converted to a revenue item within 1 year of the balance sheet date. The long-term liabilities, on the other hand, are those liabilities that are due greater than 1 year from the balance sheet date. And then our last section of the balance sheet is called the owner's equity. And the owner's equity is where we have the owner's capital accounts. So looking at this list given in the exercise, we can see as follows. Accounts receivable. This is typically money that we're going to receive from our customers in the very near future. That would be a current asset. A building has a long-term nature to it. So therefore that would be in the property and equipment category. Wages payable, this is a liability where we owe monies to our employees for pay. That is typically done in the very near future. That would be considered a current liability. Prepaid taxes, just like we learned earlier in the semester, when we prepay expenses, that is an asset. And it is always a current asset. It's going to be used up typically within the year. Mortgage payable. Well, mortgage payable could either be current or long-term. And we have two of them here. In part E of your exercise, we're talking about the current mortgage payable. That would be a current liability. But just fast forwarding a few seconds to item G, mortgage payable, but the amount due 3 years from now. That would be a long-term liability. Any amounts due greater than a year from now is a long-term liability. All right, let's work our way back up to F, supplies. This is an asset. Typically, those supplies are going to be used up in the very near future. Therefore, it would be a current asset. We've got unearned fees. That is like the unearned revenue, where we collected in advance from our customer before we provided any goods or services to them. That is a liability, typically a current liability. The capital account, this is part of the owner's equity. And then last but not least, notes payable. Notes payable, just like a mortgage payable, could be current, could be long-term, but since this is notes payable due in 3 months, it is due well before the 1 year mark. Therefore, it is a current liability. All right, so classification of a balance sheet is very important for proper presentation. Same thing with an income statement. We want to classify those sections on our income statement for proper presentation to our readers of the financial statements. Now let's look over to exercise 7. This is on page 565. And basically what we have here is we have all of our income statement items. And we list them all out here, our income statement accounts. And these were the the balances in these accounts. And what we need to do is we need to go through the closing entries. All right, and so what we're going to do is we're going to take a look at these account balances and go through the closing entries. There are typically 4 closing entries. The first closing entry is to close all of our sales accounts and contra purchase accounts. If you take a look at what is listed here in exercise 12-7, the sales account and your contra purchase accounts, that would be the purchase returns and the purchase discounts, they all have credit balances. So to close them or to make those balances 0, we would need to actually debit those accounts. And the credit in the closing entry is going to go to this account called income summary. Okay, next we have our expense accounts. Expense accounts have debit balances. We also have contra sales accounts, like sales returns and allowances. So all of our expense accounts, our contra sales accounts, all of them have debit balances. So I'm going to close them. And as you can see in the second journal entry, they're all going to get closed with credit balances. And the opposite side of the journal entry, yep, you've guessed it, this income summary account. So effectively what we've done in the first 2 closing entries is we've made all of our income statement account balances 0. And that's the whole idea. We want to start the next period with 0 balances in all of our income statement accounts. The problem that we have is now all of a sudden we have a balance in income summary. And we have to get rid of this balance in income summary. So the income summary, it actually increased, right, with a credit of $514,900. It was debited for $353,400, and if you take a look what was given to you on page 565, it had another credit balance of $103, and it had a debit balance of $87,000. So we got to get rid of all of these debits and credits. So basically, if we add up the debits in income summary, the $87,000 and the $353,400, the credits of $103,000, what we started with, plus the $514,900 from the first closing entry. If we add them all up, it looks like income summary has a credit balance of $177,500. I have to get rid of that credit balance. I will do so by debiting income summary. That gets rid of the income summary balance. It's gone. And it gets closed out directly to the capital account. And the last closing entry is when we have, when the owner has drawings or withdrawals from the account. And the owner is just basically taking a cash check. And you can see on page 565, the drawing has a debit balance of $55,000. We got to close that out to the capital account. So to close the drawing account, we'll actually credit the account, and that zeroes it out. And the debit is going to go directly to the capital account. These are your typical 4 closing entries. You close your sales out to income summary, you close your expenses out to income summary, and then you close your capital account out to income, you close your income summary account out to capital, and then you close your drawing account out to capital. Your 4 journal entries for the closing process. And last but certainly not least, I wanted to go through a large problem with you. This is problem 12-4A. And in this problem, 12-4A, we are asked to go through, to prepare a worksheet and also go through the closing process. And after we go through the closing process, also we need to adjust some accounts, go through an adjusting process, go through the closing process, and then prepare the financial statements. So the first thing I'm going to show you here is what a worksheet looks like. A worksheet is not a financial statement, but a worksheet is a tool to assist the accountant for seeing everything in one large spreadsheet. The worksheet starts off with two columns, which are the debit and credit columns of the original unadjusted trial balance. And that's actually what the author gave us. If you look at page 567 into page 568, the author gave us the original unadjusted trial balance. And we are simply listing them here in whether they have a debit balance or a credit balance. You can see the assets, the drawing account, the contra sales, and the expense accounts have debit balances. The credit balances is going to be the contra asset, the liability, the capital account, the sales account, and your contra purchase accounts. So at this point in time, you should know which account balances, which accounts have which balances. That is the first step in the worksheet, just to throw in the running unadjusted balances. And then what we do is we have to go through an adjustment process. And those are going to be the next two columns in the worksheet. Okay? After the adjustments, we're going to take the adjusted balances and either place them on the balance sheet. Once again, the balance sheet accounts would be the assets, the liabilities, and the equity accounts, or on the income statement. The income statement is going to include the revenue accounts and the expense accounts. All right, so the adjustments, and we have various adjustments here, A through F. And so let me just go down a little further and we can talk about these adjustments. Okay, so the first adjustment, what we're going to do is we're going to use the purchases, the periodic method of inventory, which means that during the period, you can clearly see we use a purchase account. We see that in the trial balance on page 568. Because we're using the periodic method to account for our inventory, what that means is we do not touch that inventory account on our balance sheet at all during the period. We only touch it at the end of the period when we physically count it. So if you actually take a look at your original unadjusted trial balance, you will see that the merchandise inventory has a balance of $50,280. That is the balance that is already 1 year old. We got to get rid of that. So the first adjusting entry is to get rid of the inventory with a credit, the beginning inventory with a credit, and we debit income summary. And immediately what we're going to do is we're going to record a second adjusting entry to record the new physically counted inventory. And your author is telling you that the merchandise inventory as of June 30th, the end of the new year, is $54,600. That comes on the books with a debit, and we credit income summary. And the next adjusting entries, we've seen this in prior class sessions, but we'll take a look at them again really quickly. Insurance expired for the year, $475. So when we bought the insurance, we recorded this asset called prepaid insurance. As the year went by, $475 of this premium has expired. Time went by, and so what we do to adjust it is we record the insurance expense increase with a debit, and the credit is going to go to the asset. We're going to reduce the asset by $475. The next journal entry is to depreciate our fixed assets for $4,380. And that journal entry, as we've learned in the past, debit depreciation expense, and we're going to credit the contra asset, accumulated depreciation. Remember, we don't credit the asset account directly. We credit the contra asset, accumulated depreciation. Next, accrued wages. So our employees worked towards the end of the year, but they're not going to get their paycheck until the following year. And we've added up what they've actually worked for us, but we're not going to pay them by the end of the year. And that comes to $1,492. And the adjustment for that is we're going to debit or increase the wages expense, and we will credit or increase the liability called wages payable. Okay, next, supplies. We see supplies, we physically count the supplies on hand. $100. All right. So what we need to do is we need to compare our physical count of $100, compare it to what we have on the unadjusted trial balance. And I see on page 567, if you look at the account called store supplies, $1,935. Well, there's only $100 worth of supplies here. That means the difference between the $1,935 and the $100 that's still here, the difference are the supplies that have actually been used. So what we will do is we will debit or increase the supplies expense, and we will credit this asset called store supplies. All right, so these are the adjusting entries, and I'm going to come all the way back up here. Basically what I just went through, you're going to get the adjustments column. All right. Now, the adjusted balances, well, like I said, if they're an asset, they're going to be an asset, a liability, or an equity. They're going to be, you're going to bring over those adjusted balances in the balance sheet columns. If they are revenue or expense accounts, you're going to bring those balances over in this column here, the income statement column. All right, and so here are your final numbers in the last two columns for your two financial statements, your income statement and your balance sheet. And now basically we can prepare formal statements. Let's look at the income statement first. And once again, a lot of these numbers are coming directly from the ending worksheet that you just saw, the last two columns, if you will. So the income statement, the first section, as we saw in this chapter, is revenue from the sales. We're going to take our sales number and we're going to subtract out our contra sales account, which in this case was sales returns. The difference is called net sales. Now our cost of goods sold section. Our cost of goods sold section, there is a formula. What we're going to do is we're going to start with beginning inventory, and this is the number that comes directly from the beginning trial balance. From the beginning inventory, we're going to add up our net purchases. So what did we purchase? Purchases of $133,050, less our contra purchase accounts. There were some purchase returns. There were also some purchase discounts. If you add up your two contra purchase accounts, subtracted from purchases, you get net purchases. That's what we purchased. Now we spent money on freight to get those purchases to us. So net purchases plus the freight gives you our purchases for the period. So what we purchased for the period, which in this case is $133,252, add that to the beginning inventory. So what we started, the beginning inventory plus what we purchased during the period, that is a subtotal called cost of goods available for sale. And just forget about debits and credits for a second. Think about this logically. What we started the year in the warehouse, plus what we added to the warehouse during the period, those would be the purchases. That is the total amount we possibly can sell. That is called cost of goods available for sale. Now the question is, did we sell all of that? And the answer most likely is no, we didn't sell all of it. So what you do at this point is you do the physical count of your ending inventory, and that's this number here, 54,600. So if I had $183,532 worth of inventory for sale, but 54,600 is remaining here in inventory at the end of the period, the difference is actually what we sold. And we call that cost of goods sold. If we take that cost of goods sold, subtract it from our net sales, which we calculated earlier, the difference is called gross profit. Some accountants would call this gross margin. They are synonymous terms. They mean the same thing. From your gross profit, you're going to subtract out all of your operating expenses, which are listed here: wages, advertising, rent, supplies, insurance, and depreciation. You add them all up, $63,292. Subtract that total operating expense from your gross profit, and you are left with net income. So net income for the period is $14,000. $1,000,000. After your income statement, the next statement that is required to be prepared is called a statement of owner's equity. And the statement of owner's equity is simply a roll forward of the capital account from the beginning of the year to the end of the year. So we're going to start the statement by taking the capital account at the beginning of the year. This you can find in the original trial balance. And if you look on page 568 and you look for B.E. Kelso Capital, you will find this number, $96,524. And as we saw earlier in this homework, in an earlier homework problem, how does capital increase? Well, it increases for the net income. All right, this net income number is going to get closed out to capital, $14,066. And where do we get that number? Well, we just calculated it on the income statement a few seconds ago. So that will increase the capital account. And what will decrease the capital account are the drawings. And there is an account also on page 568 called B.E. Kelso Drawing. And there you will find your $30,000. So it goes up by $14,066. It goes down by 30. So then there's a net decrease. Be careful. It's not a net increase in this case. It could be if the net income was higher than the drawings. But in this case, it's not. So be very, very careful. And this is how students get in trouble if they start to memorize things. You can't memorize. You need to actually understand the theory. This could indeed be an increase, but in this case it's a decrease. So if the beginning capital was $96,524 and it decreased $15,934 for the year, the ending capital is going to be $80,590. And we're going to need that number for the last financial statement that we're going to study in this class called the balance sheet. The balance sheet, unlike the first two financial statements, which are for a period of time, meaning they've got a beginning date and an ending date, the balance sheet is the snapshot statement. This is the financial statement that is as of a certain point in time. There's no beginning and end date. This is the photograph, the snapshot as of the last day of the fiscal year. So our balance sheet, we basically have the accounting equation. Assets equals liabilities plus equity. You can see our assets broken up into two subcategories. First, our current assets, and these are those assets that are going to be converted to cash or used up within 1 year of the balance sheet date. Your typical current assets, and you can see they're listed in liquidity order. We have cash, accounts receivable, inventory, supplies, and prepaid insurance. You add them all up, total current assets. And then we have our long-term assets, those assets that are going to be around for more than 1 year, typically. We have property and equipment. We have store equipment, less its accumulated depreciation, the contra asset. So if you take the subtraction, you get a net property and equipment of $7,378. Add it to your current assets, you get total assets of $92,147. That's one side of the balance sheet. And the other side of the balance sheet is going to be your liabilities and your equity. Liabilities will be broken down into two subcategories: current liabilities and long-term liabilities. In this example, we only have current liabilities. Those are those liabilities that will be paid within 1 year of the balance sheet date. And so we can see our total liabilities, which are all current, $11,557. And your last section of the balance sheet, the equity section, which includes the capital account, and $80,590 is the ending capital account. Where will you find that number? If you come back up to the prior financial statement we put together, there is your ending capital, $80,590. So the key here is to know how to use a worksheet, how to go through and prepare the financial statements, and you have to prepare them in proper order. The income statement first, the owner's equity statement second, and lastly the snapshot statement, the balance sheet, last.